Imagine waking up one morning and realizing the money in your wallet, the cash you've worked years to save, is suddenly worth next to nothing. That's not fiction, it happened before. In 1923, Germany, hyperinflation reached such madness that people hauled rent in wheelbarrows of worthless banknotes. One man, Hugo Stinnes, became the richest in Germany, not because of luck, but because he understood something profound. When currencies die, real assets survive. He borrowed massive sums, bought factories, land, and real estate, and when the mark collapsed, his debts vanished while his assets soared. It's a strange paradox. During currency meltdowns, real estate can create millionaires and destroy lives at the same time. So, what would happen to American homes if the US dollar, the world's reserve currency, suddenly collapsed? In Germany's collapse, debts evaporated. Mortgages were repaid with paper that could barely buy bread. Landlords lost everything, while property owners saw their houses sell for billions, in marks that meant nothing. In Zimbabwe's 2008 hyperinflation, people rushed to trade paper money for anything tangible: land, cattle, or homes. In Argentina, where inflation never truly sleeps, people list properties in US dollars or inflation-indexed units, not in their national peso. The pattern repeats across history. When currencies fail, real assets, especially real estate, become lifeboats. The money dies, but the land remains. Now picture this closer to home. US debt keeps climbing, $38 trillion. Interest payments already exceed defense spending. At some point, debt outpaces income. Then comes the choice: default or inflate it away. The US would almost certainly print its way out, and that's where things spiral. Prices rise, purchasing power crumbles, and confidence in the dollar cracks. Interest rates would skyrocket as lenders demand protection from the dollar's decline. Mortgages become unaffordable, new loans vanish, and the housing market freezes. Sellers wouldn't want dollars losing value by the day. Builders would stop committing to projects. How could you fix a price when a sheet of plywood costs 10 times more next month? Ironically, fewer homes being built could make houses seem even more valuable. As the currency burns, the sticker prices of homes explode. Millions, maybe billions. But in reality, those numbers mean nothing. Historically, housing in the US has risen faster than inflation. Over 60 years, home prices climbed 2,350%, while consumer prices rose just under 900%. That dynamic could turn extreme under hyperinflation, so you'd have houses selling for astronomical prices, yet no one could afford them. Real prices fall, nominal prices explode. The market loses all sense of reality. This is where the divide deepens. Homeowners with fixed-rate mortgages, the kind locked in for 30 years, could actually win big. Their debt stays the same on paper, but inflation shreds its real value. A $300,000 mortgage could effectively shrink to $30,000 in real terms. That's the magic, or madness, of inflation-induced debt destruction. Debtors win, creditors lose, but not everyone wins. If your mortgage rate adjusts or if you need to refinance, you're toast. Payments skyrocket as the Fed jacks up rates. Many would default before inflation could save them. Renters fare the worst. Landlords, facing exploding costs, would raise rents relentlessly. Monthly, weekly, even daily in the worst cases. If the government freezes rents to protect tenants, landlords could abandon properties altogether. Either way, renters suffer. Landlords with long-term fixed loans might weather the storm, their debts melt, and eventually, rents catch up. But the transition would be ugly. Vacancies, defaults, government pressure not to evict, and collapsing cash flow. Banks, meanwhile, was one wander wujumbori der isen number im shaib would jerk crushed. Fixed-rate mortgage assets would be repaid in worthless currency. Deposits and savings accounts would melt down. The 1920s German banking collapse could repeat, only this time on a global scale. It's a game of reversal. Savers lose, borrowers win, and the whole system inverts. If the dollar truly collapsed, the Federal Reserve would panic, interest rates would spike, emergency measures would flood in, subsidies for builders, tax breaks for homeowners, rent caps, maybe even a new currency altogether. That's how Germany stopped its collapse, by introducing a new mark backed by real assets like land and industry. The US could do something similar, peg a new dollar to gold, commodities, or even real estate itself. But every reset brings redistribution. The poor get poorer, the indebted become rich, at least temporarily, and foreign buyers holding stronger currencies could sweep in, buying American homes at what seem like discounts in their money. Imagine homes in California or Florida selling for pennies. If you're paying with yuan or euros, locals, despite their paper fortunes, would be priced out of their own neighborhoods. Deflation, like the 1930s Great Depression, destroys through scarcity. Hyperinflation destroys through excess. In both, people lose homes, either because debt becomes too heavy, or money becomes too light. The real lesson? Stability is the cornerstone. Moderate inflation supports growth. Extremes in either direction tear societies apart. Some nations survive with inflation-indexed mortgages, adjusting payments to price levels. But that just shifts the pain around. In a collapse, there's no escaping pain, only choosing where it lands. A total dollar collapse is still unlikely. The dollar remains the backbone of global trade. A slow erosion, not an overnight crash, is far more realistic. The dollar might not vanish, but it could lose dominance gradually, leading to what economists call financial repression, where inflation quietly eats away at debt faster than interest grows. And that's already happening, in slow motion. Homeowners with 3% mortgages have been quietly winning as inflation runs hotter than their rates. The dollar might not explode, it might just decay. When currencies fail, real estate endures, but survival doesn't mean comfort. Property taxes, insurance, and maintenance all rise in step with chaos. Owning a home becomes like having a lifeboat in a hurricane, better than drowning, but far from safe. The collapse of the dollar would rewrite America's real estate story: who owns homes, how they're financed, and what they're worth. The only thing that stays constant is that land, real, tangible land, holds value when paper doesn't. As the saying goes, buy land, they're not making any more of it. But in a world where money fails, the real wealth isn't just what you own, it's what you understand. Knowing how the system works is its own kind of currency, one that never devalues. If this helped, please like and subscribe to Express EconGeoFinance Insights. Share your thoughts in the comments below.